You are listening to Lewis on the Law, and I've got another great show for you. We're talking tax credits and incentives, and I have attorney Brian Sengson on with me. So get ready, get out your receipts, and get ready for the new year. We're rolling with tax credits.
Welcome to Lewis on the Law.
You are listening to Lewis on the Law, and you are powerful beyond measure, and I hope that my show helps you be just a little bit more powerful beyond measure. Brian, is that a right way of saying it? More powerful beyond measure?
I would go with it.
Okay, we're gonna let that ride.
Yeah.
I have a great show for you guys. We're talking Georgia tax credits and incentives. I keep wanting to say Georgia, but it's just tax credits and incentives, right?
Georgia will be a focus on a lot of it, but we don't want to exclude some of the good federal ones as well.
Yeah, don't want to exclude anything that's really good.
Absolutely.
So I have attorney Brian Sengson on with me from Bennett, Thrasher. I'm really glad to have you back. You're a return guest.
Yes. It's this will be a lot of good news as opposed to Wayfair when we were talking about a lot of bad news with compliance. Now we get to talk about tax credits.
I love it. Good news, and we're empowering people, giving them a little bit of information. Mm-hmm. Okay, so let's start this off. Now, what are we talking about when we're talking tax credits?
So a tax credit is a dollar-for-dollar reduction against your income tax liability. And it's important to note that, let's give it an example. So let's say you have a $10,000 Georgia income tax liability, and that's the check that you'd have to write, that painful check you have to write in April.
Yeah.
But if you have an $8,000 Georgia income tax credit, then it goes right against that $10,000, and so you'd only have to write a check for $2,000. So huge advantageous benefit.
So tax credit's good.
Tax credit's very good. And really what it's good to know is the why behind it. So states and the federal government, they have their own different tax credits. And what they're trying to do is incentivize or encourage specific economic results or activities. They're trying to reward that kind of behavior. And so there's an underlying tax policy that you see with a lot of these credits. And so that's one of the reasons why we always try to look for taxpayers that can actually use these, because honestly, they're underutilized.
Nice. It's good to have things that are underutilized. Now, what's the difference between a tax credit and a tax deduction? I mean, we kind of went over it, but
that's a good question. So whenever you talk about the distinctions between a deduction versus a credit, you really look at you hear the terminology of above the line versus below the line. So a deduction.
What line are we talking about?
So
here?
It is the line. So when we talk about it, it's when you're calculating your actual tax liability. Mm-hmm. So deduction only goes against your income, mm-hmm. and so the benefit is limited based off your effective tax rate. So let me give an example. Mm-hmm. You have a $1,000 deduction, and let's say you're in the new highest tax break under the new tax law of 37%. Well, that benefit is only going to
excuse me, how much do you have to make to get into that bracket?
I actually don't know. That's a good question. Yeah. I'm a state local practitioner.
I'm sure I'm not there yet, but
I'm not
just
either.
In case I get there sometime soon.
I'll know the people to call, but it won't necessarily be me. So let's say you're in that high bracket, so 37%. So that $1,000 deduction is really only provides a tax benefit of $370. In contrast, a $1,000 tax credit is a $1,000 tax benefit. So it's not subject to that limitation under your effective tax rate. So that line is taxable income versus tax liability. So it's that line that is driven by your effective tax rate that you have to pay.
Okay, now I got it. I think I've got the line now.
Yeah, mm-hmm. It's just a common terminology. There's a lot, and I will say there's a lot of terminology with this. So above the line, below the line, with tax credits versus deductions. And
I'll slow you down to simplify it for people like me.
Yeah. And you also hear about credits and incentives. And I think that sometimes confuses people. What is an incentive? Is that just another name for it? And we may not necessarily get some time to talk about it, but there are other benefits there are other tax benefits that don't necessarily follow that same mechanism of being a dollar-for-dollar reduction, but there's still benefits for individuals and companies that they can find.
Okay, so Are the federal tax credits the same as the Georgia tax credits?
So no, they're not. Well, fundamentally, let's say from a mechanical standpoint, tax credits are going to be the same in that they are that dollar-for-dollar reduction. The difference is that because we're in a federalist system, so every state and the federal, in addition to the federal government, they're their own sovereign taxing jurisdictions.
Ouch. So you're getting taxed by both.
Well, so exactly. You're being taxed by both. You pay the Georgia income tax as well as the federal income tax.
As everyone out there knows,
yes.
As we all suffer through.
Exactly. And so what ends up happening, so a tax credit, it's going to have the same effect, but it's going to apply to that specific type of liability. So a Georgia income tax credit isn't going to benefit federal or isn't going to affect another state. It's only going to affect your Georgia income tax liability. Similarly, federal is only going to affect its own federal income tax liability. There are some notable distinctions, though. So mechanically the same, but there are notable distinctions with federal tax credits versus state. Well, first, as a state and local practitioner, it's always important to note that states view the Federal Internal Revenue Code as a reference point. And then from a tax policy, they choose how they want to diverge and invoke their own state tax credits. And so there may be more fluidity. They may have shorter terms with credits. Tax policy changes a little bit more frequently on the state and local level. And so where you get into some of the differences is that federal tax credits are more well-established, long-term perspective. So a great example is the research and development tax credit. That's been around for coming up on 40 years now since it was first instituted. In contrast, you have on the state side where there's a little bit more fluidity, you'll have, say, North Carolina maybe 5 or 6 years ago they had their own state level research and development tax credit. They had jobs tax credits, and they let them sunset. They let them expire. Mm-hmm. And so, that number doesn't happen on the federal side. They will tend to renew them on R&D was renewed a couple times, but now it's made permanent.
Okay. Now, I don't know if you want to get into this yet, but what exactly is research and development? What is it? What type of tax credit is that?
So, I'm more than happy to discuss it because it's one of the key tax credits that we think we should definitely discuss.
I just want to break this down for our listeners so they know exactly what we're talking about here.
So the research and development tax credit is primarily, first and foremost, it's a federal income tax credit. And I say primarily because over 30 states have adopted it on their level as well. So when you were talking about Georgia income tax credits, there's a Georgia research and development tax credit, but with regards to the federal research and development tax credit, it is a tax credit that is meant to incentivize research and development activities. Now, I know I'm defining the word with the word, so that kind of violates that rule. And it's actually a really good point to bring up. So when we talk about research and development, the early issues with that credit was research and development as a term can be seen differently based on industry or sector or even individual. Mm-hmm. And so what ended up happening is that the Internal Revenue Service, the IRS, and they decided that they were going to institute a 4-part test. And this was going to define exactly what constitutes as research and development. And the good news is that it is far more broad than what people would anticipate. So the first part of the 4-part test is, are your activities geared towards a technical uncertainty? So technical uncertainty can be with regards to your capability to achieve a desired result, your methodology. So you may be capable, but you're not sure how you're going to get there. Alternatively, the technical uncertainty can be with regards to your appropriate design. And so that tends to be one of the bigger qualification standards. An extension of that is the second part of the test, and that is, are you implementing a process of experimentation in an attempt to solve those uncertainties? Now,
So this is mainly for the tech field or the evolving science fields?
So not exclusively. Okay. I mean, now mind you, that is where the majority of the credits are being claimed. I have had, and this is, it's always been very interesting for me because initially I was dealing strictly with software companies and then pharmaceutical, but it started to branch out as some larger companies were starting to take advantage of it. So I have had clients, very large manufacturing clients, and most notably one of the largest stock trading companies in the country. Actually,
now this is interesting. Yeah, okay, go into this. Okay.
Yeah, so this was a very fascinating client. So they're one of the largest stock trading companies, and they were able to claim this credit because on the back end they were developing the software. So you think about it, when you're buying stock and you click buy or sell, there's latency periods. There's these milliseconds or fractional milliseconds of when you hit it and when that signal goes to China or New York or Illinois, wherever it may go. And so it's all about reducing that. And so this particular company was at the forefront of developing software to reduce that time to fractional seconds that I wouldn't have even thought about counting. But to them, every fractional second that they could save was important. And so from their end, they were able to qualify for research and development. Manufacturing companies, breweries are actually one of them. I have a brewery client that claims research and development tax credit.
Nice. Well, there is some science involved in that.
Absolutely.
I guess you can call that science or whatever.
I mean, you think about it. I mean, that's the fun part about doing the interviews with the clients. But I mean, you get some very interesting clients, and because when you're getting into some of these technical requirements, we talked about technical uncertainty and process of experimentation, a lot of times people's perceptions tends to be the primary barrier to these credits. You have these qualifications, but I have had lengthy discussions with employees to my clients where they are adamant that what they do is not research and development. And it's interesting where we have to actually clarify for them that just because it's their perception doesn't mean that under the letter of the law it isn't research and development.
So this is a great subject. We're really getting into this. We're up against a break. I want you to give them a little contact information for you.
Yeah. So Brian Sengson, you would find me on the Bennett Thrasher website, and my direct line is 770-635-5041.
You're listening to Lewis on the Law. This show comes to you each and every single week to empower you, the listener. We give you legal information. This show does not give you legal advice. If you need, if you have a serious legal issue, go ahead and contract with an attorney. When we get back, we're going to talk about some notable tax credits. You're listening to Lewis on the Law. You are listening to Lewis on the Law, and that is Tax Free by Jimi Hendrix. I know we wish we were tax free, but we're not. And because we're not, I have attorney Brian Sengson on with me from Bennett Thrasher. And Brian is our local assault. You're a salt guy, right?
Salt guy, state and local tax. So yeah, we go straight salt.
Yeah, okay. So that's why I kept wanting to throw Georgia in there. But we're not really talking Georgia. We're talking tax credits and incentives. And if you have a topic for this show, contact me on my website at jameslewislegal.com. You can drop me a line on my contact page. And if I can't cover your topic, I'll bring on an attorney who can cover your topic. You can also call me at 404-610-0075, or you can email me at james@jameslewislegal.com. Now, Brian, before we get back into this, give them some contact information for you once again, real quickly.
Yeah, so Brian Sengson, you'd find me on the Bennett Thrasher website, and my direct line is 770-635-5041.
Okay, so we were talking tax credits. We're going to get back into research and development in a minute. But first, what other type of notable tax credits should we know about?
So there's some big ones that I hope that we get some time to discuss. So research and development is a big one. It's federal and it's state. A really good advantageous one for the Georgia side is the Georgia Jobs Tax Credit. And then there are, and these are both for businesses. Another one that's more of a second tier for businesses is retraining tax credit. And I think for individuals, you could also look at the any transferable tax credits, most notably the film tax credit, which a lot of your listeners may be familiar with, given all the film production activity here.
Yeah, I think they might be familiar with it, but I bet they would like to know more about it.
Oh, absolutely.
So before we do that, let's get back into the R&D tax credits. How can someone take advantage of this? So
first and foremost, it's all about getting a good practitioner who does this. I've been doing this for a number of years now. Research and development tax credit is near and dear to my heart. It's what I started doing right out of law school. And it is something where you see a lot of people. You see some practitioners that don't necessarily provide the kind of deliverable exactly. They don't do as robust of a study as you need to do. So lean on your CPA. They may have a good third-party reference. If not, poll the industry, find some people, and get some references. And so as far as taking advantage of it, that would be the very first step. The second of all is that internally, if you just want to have this kind of discussion of assessing whether or not it's a good credit for you, you'd want to look at whether or not you qualify under that 4-part test. Just get some general assessment of, are the activities that we're doing, are they meeting that 4-part test? And as a rehash, I think we got through 2 of them because they're the two most important ones: the technical uncertainty, the process of experimentation, which I should say, a lot of people think, and
so wait a minute. I'm still trying to get around this technical uncertainty part of it. Okay, so you said companies that aren't tech firms and that aren't like science companies are actually accessing this credit.
Yes.
So how are they doing that with technical uncertainty with that first requirement?
So the technical uncertainty aspect, it actually loops in the third part of the test, which you have to use principles of a hard science. So so it's meant to exclude soft sciences. So economics, psychology, those aren't going to be qualified. But if it's a hard science, say mathematics or engineering or computer science, so any software company, they're going to qualify. And so while it may fall in line with like the medical field or some very high-level technology companies, there are means in which, so say like a brewery, I gave that brewery as an example, or a stock trading company on the back end.
Yeah, the stock trading company. That's really piqued my interest, was how do they qualify?
So they're using internal use software on the back end. So they're developing their own internal system to handle it. And that heightens the requirements from an uncertainty perspective. But in and of itself, even though the forefront, you can't just look at the industry. I think a lot of taxpayers out there say, well, I'm in X industry, and therefore I shouldn't qualify for an R&D tax credit. That doesn't make any sense. But if you're undergoing activities that have these technical uncertainties, the principles of a hard science, if you're implementing these on a daily basis, you might want to look at it. And so the technical uncertainty, again, I think it's a good point that you're bringing this up, because it is the most difficult part of the test to meet, and you have to really do a rigorous review under a study.
Yeah, it seems like a threshold issue there.
It is. And so you do that on the technical uncertainty. Process of experimentation, it's really just a matter of, are you evaluating alternatives? Some people think you have to be in a lab, but really, James, you and I sitting here at this table talking about this, if we were talking about evaluating different alternatives, just a think tank session, that qualifies.
Now, that's really intriguing, because I'm trying to develop out another area of my practice that I was really involved with right out of law school. But, I'm doing a lot of commercial leases these days, and that's not quite as exciting, but I've got this plan to kind of branch out into communications infrastructure and offer that to municipalities. And so this intrigues me here, and I wonder if there's an application for me here.
Well,
but I've stopped you. Go ahead, go ahead. I keep stopping you past that. We don't get past the second requirement.
Well, yeah, no, that's absolutely fine, because those are the two most important. The third one is principles of a hard science, which is fairly easy to meet as long as it's really on its face. The last one is are your activities intended in resulting in a new or improved product or process? And I want to break that down. So when I say intention, that emphasizes the fact that you don't have to succeed. Most of the good R&D expenses are failures.
Yeah.
And so those headaches that a lot of companies have, I can't tell you how many times I'll walk in and I'll talk about the research and development tax credit. And I usually, one of my first questions is when they're trying to figure out, well, what are some of the good activities? I usually ask, what gave you a headache last year? And those are the ones that are research and development. And so we talk about intention, so it doesn't have to succeed, new or improved product or process. And so when I talk about products, new or improved products, you don't have to recreate the wheel. You don't have to go from no phone to the iPhone X. Instead, you can go from the iPhone 8 to the iPhone X.
Yeah.
And just that small leap of features and functionality, that in of itself is going to justify the credit. And when we talk about products, that's one aspect, but also processes. So if you're a manufacturing client, this is one way in which manufacturing clients actually do qualify, is they may not necessarily be doing something that's unique from a product standpoint, but they have a very uniquely streamlined and efficient way of doing it. Maybe they add a new piece of equipment and it cuts their manufacturing time in half. That's a research and development activity under the test.
Okay. So what is the audit risk here?
So the audit risk, no tax practitioner can ever deny that there's an audit risk. Where a good
there's always an audit risk. Especially
now,
when you're stretching the boundaries.
Exactly, yeah. And that's where you get into having a good service provider that's actually handling it. The audit rate is probably about 8% based on the amount of taxpayers that claim the credits.
Now, is that high concerning other tax credits?
So it is relatively high, I would say, because historically, the IRS used to have what's called they used to tier their issues. So Tier 1 was the ones that they deemed that could be subject to more abuse, and the research and development tax credit was a Tier 1 issue. They've done away with the system, but quite frankly, the IRS is slow to change, and a lot of those auditors are still with the IRS, and so they tend to perceive that. And in my handlings and dealings with IRS auditors, they see this as they tend to be a little bit more aggressive, and they almost assume that if you're claiming the credit that you're taking advantage of the government. So. And that's not the case. If you do it right, then you're not necessarily taking advantage of the government. It's a federally permitted tax credit, and it's also permitted at the state level as well. And so, from an audit risk, it's really where the question needs to be focused for any of your listeners that are considering this credit. Is there a failed audit risk? And that's where you get into what makes up a good research and development tax credit study. And it's getting the documentation, it's getting project interviews. It's a very extensive effort, but it's one that is suitable because at the end of the day, if you were to get audited, you'd be able to hand over this deliverable that documents everything, and it would solve the audit right then and there. That's the intention, at least.
That's the intention. Okay, that's pretty good. So we were talking federal. Let's get into Georgia a little bit. What type of Georgia tax credits are we going to talk about?
So my favorite Georgia tax credit, because it's recently I've been able to build a practice off of it, is the Georgia Jobs Tax Credit. This is incredibly advantageous. So on its face, it's pretty self-explanatory. It is a tax credit that is directed towards companies that are hiring new employees. You have to be. There are some qualification standards that we can get into. You have to be hiring them where they are subject to Georgia payroll withholding. So out of state, even if you're based in Georgia, but you're hiring out of state hirings, those aren't going to qualify. They have to be full time, and they have to be offered health insurance. They don't have to accept it. And there are some specific wage threshold requirements. The most recent one, and those change every year. The most recent one is an average weekly wage of $480, which comes at about a box 1 W-2 wage of just under $25,000. So it's a relatively low threshold, and a lot of people can qualify for it. It's just a matter of it's all location based. So to give some backdrop on this.
Yeah, let's get into that. What do you mean by location based?
So what happens every single year is the state of Georgia actually categorizes counties into 4 different tiers. And so the tier 1 are the ones that are more economically challenged, less developed. The ones that are more local to us that your listeners may know of are Clark County and Clayton County are tier 1 counties. Conversely, tier 4 counties are the really well-off counties. So your Cobb County, your Cherokee County, or Oconee County. So what ends up happening is the way that the state does it is they provide this shifting threshold. So if you are in a tier 1 county, the economically challenged county, you only have to have a net increase of 2 employees, and you get a credit of upwards of $4,000 per new employee hired. And so that can be pretty beneficial. So if you meet the bare minimum,
$4,000, yeah.
$4,000 per employee.
Nice.
So if you hire 10 people, you can get a $40,000 credit.
That's incredible.
Yeah, and alternatively, if you're in the tier 4, I don't have a lot of tier 4 clients because the bar's so high, but you would have to hire 25 people, a net increase of 25 people, and you'd only get a maximum of $1,250 per new job.
This is really good stuff. We're up against a break again, though. So one more time, Brian, give them some contact information for you.
Sure. So Brian Sengson, you'd find me on the Bennett Thrasher website, and my direct line is 770-635-5041.
You're listening to Lewis on the Law. My name is James Lewis. I'm your host, and I come to you this week, each and every week, to bring you empowerment through the law. That's right. We're trying to empower you, the individual, with our legal information. This show is only designed to give you information. It is not designed to give you legal advice. If you have a serious legal issue, contact an attorney. You can always contact me. I can help you out. I have a lot of attorneys come through my show. I can always steer you towards one. I'm an attorney myself, and if you have some sort of land, real estate issue, go ahead and contact me. I can use the business. You're listening to Lewis on the Law. When we get back, we're going to get back into Georgia tax credits. You are listening to Lewis on the Law. My name is James Lewis, and I am your host. You can always contact me at jameslewislegal.com. If you have an issue or a topic that you'd like to hear discussed on this show, go ahead and drop me a line. If I can't handle your legal issue, I'll bring on an attorney who does know something about your legal issue, and we'll get to it on air. It may take a month. I book about a month in advance, so I know some of you guys who've sent me stuff are a little, when are you going to talk about my show or my idea? And I'm like, I'm getting to it. In February, I've had a lot of questions on Medicare, disability, Social Security, that kind of stuff. We're getting to all of that in February. I have attorney Brian Sengson on with me from Bennett Thrasher. Yep. Brian, will you give them some contact information for you?
Yeah, so Brian Sengson, you can find me on the Bennett Thrasher website, and my direct line is 770-635-5041.
So January is it's tax season. Isn't that exciting? January, we're focusing on tax. Brian is here to give us tax credits and tax incentives. Mm-hmm. So we were getting to Georgia tax credits. You're talking about tier 1, tier 2, tier 3, tier 4. Is it always a hard and fast rule that tier 1 is your bet? Is there anything that might change that factor?
So yeah, there is. And so the states will have these general tiers, but then you think about it, that's really discouraging for companies in Cobb County or like right there. That'd be very discouraging. So what the state does then is they then put on these added layers, these different zones and designations that disregard. So if you're in a tier 4 county, but you happen to be in these favorable zones, so some of them are opportunity zones or military zones, even a less developed census tract is another one. And what they do is they basically set aside, it doesn't matter if you're in a tier 4, if you're in this zone, then you may qualify, and you actually have these lower thresholds. So it brings it back to, it's almost like, so you can be in Marietta, and there's some opportunity zones around Marietta. I think of that because of Cobb County, and rather than having that 25 job threshold, you only have that 2 job threshold. and you get a $3,500 credit per new job created.
Oh, that is awesome. So are there limitations to this?
So there are limitations. It depends on where you're located. Again, because of the different tiers and the different zone designations, there's a lot of layers to it. But if you are if you're not in an opportunity zone or in the bottom 40 of the tier ones, they actually rank them by number. If you're not in any of those, if you're outside of that, then you actually have to be what's called a qualified business enterprise to qualify in order to claim the credit. And the way that the state does that is they have this very long list. Are you familiar with the NACIS codes, NAICS codes?
I am not.
So on tax returns, you actually have to identify what industry and sector that you're a part of. So what categorizes you?
I have seen that.
So it's called. We have internal discussions about is it NACIS, is it NAICS? I say NACIS, and I'm right. So
that's always the attorney response. I say it, and I am right.
So that is how Georgia defines a qualified business enterprise. Is they provide this laundry list of qualified NACIS codes, and they say if you are, and that gives some general categories: manufacturing, distribution. I believe some research and development is another one of them. But they provide all these lists of numbers, and that if you fall within those, then you're a qualified business enterprise, and you can claim the credit, assuming you meet the other requirements. The problem is obviously is if you meet everything else, but you don't meet that code for whatever reason. But I will say it's an administrative code, and so a lot of times I'll have clients that are close to it, and we might do an evaluation of the company and say, can you put it as this code instead? Can you qualify yourself as this, and you'll get the credit? And more often than not, that's usually the case. And so there's that limitation where there's an added qualification requirement. Additionally, if you're in, say, a Tier 3 or a Tier 4 county and you don't have any of those other favorable designations, then you can only use the credit. It's an income tax credit against your Georgia income tax liability, and you can only use it against 50% of that Georgia income tax liability. So there's that limitation as well.
Okay, so the workforce and the workplace is really changing and evolving, and more people are working from remote locations. They're working from home-based jobs.
Mm-hmm.
So how does this affect that?
So if you're an employer and you're hiring remote employees, more likely than not, it's not going to qualify because, again, it's a location-based credit. They're trying to incentivize you for you hiring in these specific locations. So more often than not, it's not going to qualify. Even traveling salesmen, probably not. There are some lines, there's some different gradations that you have to consider, but more often than not, no. And there's even some others, so like leased employees. So if you think about when you have a startup company and then you start and there's that growth stage, at times it's expensive to get benefits, and so some taxpayers will actually get what's called a professional employment organization, and a PEO is what it's referred to, and it's a firm that you assign. They handle benefits, workers' comp, and even if it's technically under contract, they're employees of that firm that you've hired, but under common law, they're still your employees. So arrangements like that don't prevent the credit, which is always important to note.
Okay, so are these Georgia tax credits, are they lucrative?
They're incredibly lucrative, and there's two big reasons why.
What makes them so? What makes them so lucrative?
There's two big reasons why, and one I don't think it's talked about enough. So the first one is the payroll tax withholding benefit. So if you are a company where let's say you don't have a whole lot of Georgia income tax, but you have a lot of employees, maybe you have a lot of losses, or for whatever reason, you're just not generating a lot of a profit, but you are hiring a lot of people. You still want to be rewarded for that, but because it's an income tax credit, as I mentioned, it's a dollar for dollar reduction against your income tax liability. But if it's capped because you don't have a lot of income tax, what's the benefit? Why would you be doing it? And you end up losing out on a lot of these credits. Well, Georgia permits companies to file an election after they file their returns and basically say, I don't want to use it as an income tax credit. Instead, I want to use it against Georgia payroll withholding. So if you get a company will take out take out some state withholding, and then they have to remit it to the state. Under this provision, they don't have to remit it to the state. So they get to take the money and they get to hold it, and it's a way of making the credit refundable. So rather than having to write the check it's another way of being able to rapidly monetize the credit, as opposed to having to wait these 10 years of funneling through these credits year over year with a limited cap. So it's a huge benefit.
Nice. That is awesome.
Mm-hmm.
So once again, we have to talk audit risks.
Yes.
Mm-hmm.
So the audit risk with that, and actually I will say before jumping into audit risk, the other benefit that actually doesn't get talked up enough is the 5-year window. So James, if you, in fact, I looked at your firm's location, you're in an opportunity zone. So you have that 2-employee increase with a $3,500 credit. If you were to claim that, let's say you hire 2 people at the beginning of this year and you're able to claim that credit. So you get a $7,000 credit. You're welcome. And
yeah, I can use that $7,000 credit.
I think all of us could, right?
Yeah.
And so let's say that going forward for the remaining 4 years after you claim that credit, let's just say you just stay put. And assuming that everyone meets the wage thresholds, every year for the next 5 years, so from 2018 to 2022, you get to claim a $7,000 credit. Now, I've got clients, think about this, that's the most minimal threshold. Let's say you keep hiring, let's say you hire 4 people, then 6 people, then 10 people, and it keeps building off of that. So there's these shifting ladders, essentially, of these 5-year windows where you're able to keep claiming the credit. So if you hit a growth period, I have clients that are claiming over $100,000, a couple that are multiple hundreds of thousands of dollars in tax credits because they have huge growth periods and they're almost compounding upon one another where, one year they have 20, the next year they have 40. And it's just not, so then in the year 2, it's 60 total jobs that they've created since they started. So it is a huge benefit that, quite honestly, I think people, they just see a $7,000 credit and they're very grateful. But in reality, I've got you a $35,000 credit over the course of the 5 years.
Nice. Now we're talking real money.
Yes, and with real money comes audit risk, as you alluded to.
Yeah, and that's what we've always got to touch on, the audit risk.
Yes, and so similarly with research and development, there is no practitioner that can prevent and that can say there is no audit risk. The Georgia Job Tax Credit isn't heavily audited. However, I will say similar to that, it's all about getting a good practitioner. I feel very lucky in the fact that 2 doors down from my office is Peter Stathopoulos, and I'll mention him again, but he's a partner with my firm, and he actually wrote the regulations on the jobs tax credit. So if I have issues and problems, I'm able to walk 2 doors down and just pick his brain and say, hey, what'd you mean when you wrote this little regulation here? And so it's always a great person to pick his brain on.
It's great to have a person like that around. When I went to work for the Atlanta Beltline, the general counsel for the Atlanta Beltline had written the Georgia law and the Uniform Partition Act. So she had actually written the laws on, and she was the Georgia bar president for her term, and she'd actually written the laws. So I became a de facto expert on that. Like the Georgia Heirs Property Project, they'll call me and refer clients to me. So, it was great, and it's invaluable to have people like that.
Absolutely. You pick up that expertise by osmosis as well as practice, right? So as far as an audit risk, this is more, unlike research and development, which is more fact-driven, the jobs tax credit is more data-driven. And so it really what you have to lean on is if you have a payroll company, do they have good data? Are they providing good data? Also, again, the practitioner, are they able to identify some of the inconsistencies in that data? That's a lot. Whenever we're doing the jobs tax credit, that's where our primary focus is at.
Okay, so we're talking audit risks here again. Okay, so where are we with this? I mean, is this a low risk? I mean, you said it's basically a low risk.
I would characterize it as a low risk. Georgia doesn't necessarily have an audit risk tier structure.
Because that's what I was looking for. I was wondering if there's a tier structure here.
No, not that I'm aware of. Maybe historically at one point they did have it, but they don't have one in place. And so jobs tax credits. It's more so just about getting the appropriate calculations. I will say that from an audit perspective, there have been some horror stories that I've come across where clients have come to us. I've reviewed their job tax credits, and there are some third-party practitioners out there that get their fees on a percentage of the credit. So they tend to leverage that and overclaim credits. And so it can create a situation where, like for one of my clients, they overclaim credits unknowingly for them, but the practitioner overclaimed it for over $300,000 in credits.
Oh,
now we got it corrected.
Yeah,
but again, that's why good practitioners is what matters.
Okay, we're up against our another break. We're moving into our last segment. Brian, will you give them some contact information for you?
Sure thing. So Brian Sengson, you can find me on the Bennett Thrasher website, and my phone number is 770-635-5041.
You're listening to Lewis on the Law. When we get back, we'll be moving into our last segment. We'll kind of wrap up where we've been and see where we're going to go. You're listening to Lewis on the Law. You are listening to Lewis on the Law. My name is James Lewis, and I am your host, and we have an awesome show going for you guys today. January, it's tax season. Everybody has to face taxes. There's one thing in life that you can't avoid, and that's death and taxes. I know it's a cliche, but you know what? It's the truth. I just played tax-free for you, but there's nothing that's tax-free. And if they say it is, they're going to get you somewhere else. I have attorney Brian Sengson on with me from Bennett Thrasher. We're getting into tax credits and incentives. And Brian, why didn't you kind of take us through where we've been? Because we've talked a lot. We've given them a lot of information. So let's just kind of touch back on where we've been.
Absolutely. So tax credit is a dollar for dollar reduction against your income tax liability. And a credit is different from a deduction. A credit is better than a deduction.
Better.
It's
we
far more
like
advantageous.
better.
Yes. And so a tax credit goes right against your tax liability, whereas a deduction only counts against your income. So it is limited based on that effective tax rate. So there's that distinction. So we always want to focus on tax credits. That's a great conversation. That's more beneficial. And then we've also talked about two particular credits that are near and dear to my heart. Research and development tax credit, which is a federal tax credit. However, some states, also including Georgia, have adopted it. And so it is a credit that incentivizes research and development activity. That said, that activity is defined as where you have a technical uncertainty with regards to capability or methodology or appropriate design, and you implement a process of experimentation to solve that uncertainty. And in doing so, you implement principles of a hard science with the intention of creating a new or improved product or process. And shifting over to the state tax credit, the one that I've been dealing with a lot more recently is the Georgia Jobs Tax Credit. And that is a credit that incentivizes hiring in the state of Georgia. They do so by means of having favorable tiers. So Clayton County or Clark County are some of the examples for tier 1 that are more or less developed. So they provide a very low threshold of only 2 net hirings of an increase and upwards of a $4,000 credit per increase. Similarly, there are, regardless of what tier you're in, they provide opportunity zones. So you could be in a Cobb County, which is a tier 4, but you still have that 2-job threshold with a $3,500 credit per new job created. So incredibly lucrative credit as well, and underutilized.
Okay, and you touched on job retraining credits.
Yeah, so there is also a retraining tax credit. We discussed that in the first part of our segment. So it's a bit of I would refer to it as like a second tier of a credit that you want to evaluate. So a retraining tax credit is, it doesn't matter what kind of industry you're in. Any company can claim this. It is a Georgia income tax credit. You don't have any of the other benefits where you can possibly use it against payroll withholding like you can with jobs or with research and development. Instead, with retraining, it's just income. And then what the focus is on is where you have to do a retraining. So not onboarding or anything like that, but is where you're doing retraining, where you're investing in your employees in say a new technology or a new equipment. And the standard that's in the statute is where, absent the retraining, an employee would be displaced. And so
developing a skilled workforce.
Exactly.
Mm-hmm.
And so it's
or
always
a better
about
skilled workforce.
Exactly. And so you don't necessarily want, I think they're always concerned about having isolated workforces that tend to fall out and lose a skill. And so they're no longer marketable as employees. And so that's always a concern. And so obviously you want to incentivize that. Now, the retraining tax credit, there are some good and there's some bad with that credit. And it's maybe more so from the tax practitioner side, where it is, the good of it is that there's some added administrative processes. So we talk about an audit risk with some of these other credits. Mm-hmm. It's a very low audit risk with retraining tax credits, in my opinion, because in order to claim the credit, you have to run your application through the technology college system of Georgia. Mm-hmm. And so there's an added layer of review and discussion with these officials before you even put it on the return. So it's almost like a pre-audit audit, mm-hmm. and there's no penalty or anything like that. They just basically follow up, ask some questions, make sure it's all good. You're able to put it on the return, and then you actually get a signed certificate from that agent. The bad with it is that, and this is one of the reasons why I would put it on the second tier, is that the credit structure isn't as favorable as it should be. I think if I was ever elected, and I'm not political, I'm not running or anything like that, but I think that would be one thing, is I think that this is a really good credit, but they put caps on it from a credit perspective. You can only get upwards of a maximum of $1,250 per employee per year on retrainings. And that's if they do multiple retrainings. And it's a cost-based credit, so it focuses on wages, similar to other credits as well. But because of the caps, it's very hard.
It doesn't seem very significant.
It isn't. It isn't. You have to have, it has to be under the right circumstances where you have a company-wide implementation of, say, a new technology, maybe on like a time tracking system or something where it takes a lot of time where they have to figure it out, like a new database. It has to be the perfect circumstances, because otherwise it's just not going to, there's not going to be a good return on investment with regards to the amount of time that's taken to calculate the credit and justify it. It's also, from a documentation perspective, it's administratively burdensome. You need to get sign-in sheets for every single retraining. If you don't have that, it sometimes is a bit of a struggle for taxpayers to get that information.
Okay, so now we're to the exciting part of our show.
Yeah,
I mean,
it's all exciting.
Yeah, but it's especially exciting when you talk about the movie industry here in Atlanta, because it's growing, it's burgeoning. You know, people are excited about it. You know, so Georgia film tax credits. What do we get? What have we got?
So the Georgia film tax credits. This is something. So I mentioned Peter Sathopoulos as the partner. He actually also wrote this law, and so this is something that he's built his practice on. He's
just the guy to go to, huh?
He is the guy. I'll give him a lot of credit. So I hope he hears this. So with the film tax credit, to give some history with it. So Georgia was a film destination back in the 70s. So like Deliverance or Smoking the Bandit, basically any Burt Reynolds movie.
I remember Deliverance. I didn't actually see the movie, but I've heard about it.
Yeah, so they were filmed in Georgia. And over the years, it somewhat died away because states such as Louisiana offered this
Have
film
you ever
tax
done
credit.
any whitewater rafting?
Yes.
Yeah, the Chattooga River. Every time I go up to the Chattooga River, the guides are always like, and this is where Deliverance was filmed. And I'm like, can you hear the banjo off in the distance? I'm just like, it's not something I want to hear.
See, I haven't done it on the river, but I do want to do it there now. And so
the Chattooga River is the fastest whitewater run in the South.
See, you learn something new every day.
Yeah, exactly.
I love it. So with the film tax credits, this is a tax credit that benefits production companies. And so on its face, you might say, well, why is this even worthwhile for me? Well, Georgia, when they started to lose that film production, they wanted to get competitive with it. And so they introduced this law, I believe, as early as 2002. And what they did is so this is also an income tax credit. And so it benefits production companies, but really where the benefit is for your listeners and for any Georgia taxpayers out there is it's a transferable tax credit. So unlike any of the other credits that we've discussed, where you have to be the party that earns this credit and claim it, the Georgia film tax credit, these production companies, so Warner Brothers and Sony Entertainment, they can put these up for sale. And so you yourself can buy these tax credits. If you have a $10,000 tax liability, you can buy these credits to count against that Georgia income tax liability. And the real benefit is it's not just a dollar for dollar with purchasing it. You tend to buy it at a market rate. And so it can vary between 88 cents to 92 cents. So if you're paying essentially your $10,000 Georgia income tax liability for $8,800, I would do it, wouldn't you?
Yeah, I would do it. And there's something very similar with land use. There's something called a conservation use easement.
Yes.
And people can, and I guess they've cut back on it, but people were selling their conservation use easements, basically setting aside land for agricultural rural development, and then people were basically giving them money to develop that land, and they would get almost double the money they put in back as a tax credit.
Yes.
It was incredible.
Yeah, I interestingly enough, actually, when I started doing state and local tax, conservation easements was the very first thing that I dealt with.
Oh,
so
okay.
This is kind of out of scope for our topic, but it is a huge benefit because it became a reported transaction.
Now, when you started talking about this, that's what it immediately reminded me of.
Yeah, absolutely. So that's a huge benefit. Maybe for another show, it'd be a good conversation because it's still available, but it's just now it's under a lot of scrutiny on federal and states.
And the selling of it is really what's been frowned upon.
Well, there's a lot of people that, as you see with any level, there's a lot of people that are abusing. You were talking about getting back twice your money. I know the real perpetrators that made this an issue on the conservation easements were selling it at 8 times the amount that was invested.
Yeah, exactly. And that's why the incentive on something like that is incredible.
Absolutely.
Okay, I'm sorry. I stopped you because as soon as you started talking about that, I'm like, wow, that reminds me of a conservation.
I think we're just gonna continue this on into another radio show on the conservation. So going back to the film tax credit, the primary question a lot of people will ask is, well, how do I take advantage of this? And primarily, you want to go to your CPA. They will likely have a relationship with the broker. If they don't, you may want to look elsewhere. Look for a CPA that might have it that deal with some individual tax issues. or you might just want to be able to have a relationship with a broker directly, should I say. And this is something that is very popular. It's popular amongst the people that know about it. So I think in a healthy market, about 400 to 500 million in Georgia film tax credits are purchased or transferred every single year.
Wow, that's incredible.
Now, obviously, a lot of those people some of those people that are doing it have substantial income tax liabilities, and so they're purchasing a lot of it. But this is something that they're still out there. I mean, you're able to get this early on in the year, and you can get a really favorable rate with it. So it's highly encouraged, and it's something that, and there's other transferable tax credits out there, low-income housing and some others.
You know, we have to do a show just on transferable tax credits. There might be a show just on that issue
itself. It might be something that we'll take a look at. And obviously, that's more focused towards the individual. So it can, I think tax credits themselves, it proves that tax credits can hit the entire scope.
Yeah. You know what? We should have put this topic at the beginning because we're not going to really flesh this out. Brian, we're reaching the end of our show. Why don't you give them some contact information for you again?
Yeah, so Brian Sengson with Bennett Thrasher. You would find me on the website, and my direct line is 770-635-5041.
This has been yet another great show. You're listening to Lewis on the Law. My name is James Lewis. Next week, we'll have attorney D.A. Wilson come and talk about taxation on real estate transactions. I would like to thank the guys who actually make this show come together. Our sound producer over there, Sam Davis, the enigmatic one. Our genius of video, Anthony Cook. Without you guys, this show couldn't happen. You guys are making it look and sound great. Thank you. I'll see you guys next week.